Happy Saturday, and thank you very much for being with us the first week of October. I hope you all had a wonderful week. And here we go, another exciting week we had in the markets. And I think the excitement will continue. So if you felt that you had missed opportunities, I think you're going to have many more opportunities knocking at your door. So as always, we're going to start the economy. And one of the reasons I really emphasize the economy, as you have noticed, it's really been the driving uh, force in the way the markets have been behaving. So last week was another indication. This coming week is important. So you see, that's the reason we want to emphasize what's going on from the macro uh, point of view, from the economic point of view, rather than just specifically talking about individual stocks or individual issues of different investment classes. So they all go hand in hand. So again, the markets were very much exciting. So we'll talk about that. Got quite a few slides on emerging markets, mostly lessons, and they are mainly statistics. Hopefully they're helpful. We've got a few lessons of the week. I'm going to share trading that I did last week, also what we should look forward to as far as, especially in the futures market. Screen of the week, we always look at the squeeze, but also we will, I got another ideas on the screens, but also we are getting ready for the earnings season. So next Thursday and Friday, be ready. It's really starting, and we will talk about that. So it's very important, and again, pay attention and the earnings, because I think these are going to be very crucial, especially the banking starting next week with all the big banks. It is going to be a very good indicator what to look forward to, what they are looking forward to, what they're thinking about the consumer behavior, and the effects on the economy and their upcoming earnings. So it is really the full. We are on a high gear. So be prepared. So as always, we look at under the hood. You see this initial jobless claims. It was a little up last week. Actually, it's a little bit up, but it's still, we are better than we were in 2019. So that goes hand in hand with the employment number, the JOLT number. So that's important. And you can see again the continuing jobless claims, the cumulative better than the 2019 improvements. And basically, again, the services, I look at the global commercial flights. We talked about that. So we see that hotel occupancies are improving month over month, although we're still below the 2019. So those are the things I pay attention. The main thing last week was a really big one everyone was waiting for. And I think we discussed that. And I mentioned it last week. Please pay attention. The markets, we can become emotional. That fear of missing out comes in, and we just want to be ahead of the game. Unfortunately, you have to be patient. You have to be really have everything in order before really making a big bet. You can make small bets, which we will discuss. But I don't think the markets are still ready. They haven't given us a green signal yet. So the markets were waiting for this, the non-farm payroll. So if you notice, what happened was really the markets had a big down day yesterday after the numbers came out. And basically numbers were at 263,000, and the expectation was 250 to 255,000. And last month was the 315,000. So you would say, well, for the sake of 8 or 13,000, how could market react so much? So we'll discuss it in the next couple of slides. I'll go under the hood and we can analyze it a little more. But that's how the really volatile the markets are, very reactive to the data. So basically, we were hoping, it will be a bad news. We will have much lower employment, and by having this healthier employment, we are giving giving the excuse for the Fed to become, follow their path, which is, raising the rates. The goal is right now, the Fed is meeting November, well, they will be on November 2nd. That's next meeting, which that means this employment number was the last one that they had. And then next following week, we'll talk about the CPI numbers. That will be the last one. That's what the markets are paying really attention to, these numbers, because the Fed will not have another one. So that's why they, the odds went up very much that they will be a 75 basis point. Well, before this, the odds still were favoring 75, but there was a good odds for the 50 basis point. So we will discuss the other thing they emphasized was this 3.5% unemployment rate, which I will further. So this is how the last week worked, and basically going the employment numbers. Again, the 263,000 came, was a little higher than what was expected, but the big thing was the civilian employment, which is the jobs that are the small business startups. They rose 204,000. The weakest part of the report was that it was the labor force ranked by 57,000, and although it was increased in August. So, but one thing again, the market really focused for whatever reason on this 3.5%, which is the lowest since pre-COVID, and it goes back all the way to 1969. This is the time, the lowest number, that we were at 3.5%. And basically, the reason for that was we had, again, the participation rate went down. So basically, there was, as far as the jobs, the denominator became, in a sense, larger, and denominator was also large. So basically, accounting, it was more of accounting, it became 3.5%. So what you see that we also have, we had the JOLT numbers, but voluntary job leaves, which were the leavers or the quitters, it reached 15.9%. Why this is important? Because it tells, again, this tells Fed that people are willing to quit their jobs because they think they're going to find a better job. So there is still belief in the strength. Another interesting, which I haven't written here, is the majority, there was a big move, about over 350,000 new jobs for people who were 55 and over. So there's a lot of movement in a, I would say, higher ages. And another interesting factor was obviously the restaurants, the service, the leisure had the growth, but also most people would think with the slow in real estate, it was actually growth in the real estate market as well. So that was another interesting factor. So another thing you have to take into consideration is the earnings, the wages. That's what the markets look at, because if we have higher wages, that means that as far as the purchasing power, that's higher purchasing power. So basically the wages, they grew by 0.3%, which that means they're up 5% year over year. On the other hand, the inflation is at 8.1%, so we're still not caught up with that. If you multiply the number of hours, which also increased, then times the wage increase, then we will be ahead of that. But that means people are working more to make the same amount of money, so to keep up with the inflation. So these are important to understand, that that's the reason the market was really got jittery. Again, they think that there is that still the factor of a healthy work market, job market, and as I mentioned, the jobless claims, they went 219,000, although increased 15,000, as was a cumulative million. So that was the reason the markets really reacted. So upcoming week. Again, you really got to be on your toes. If you want to be a trader or investor, you really have to constantly make sure that you are ahead of the game. You're prepared. I know some of you even have the notes on the side, so you know what's going on. For instance, we have Monday is Columbus Day, or some people call it Indigenous National Day. Basically, the equity markets are open, but the bond markets are closed. So just remember that there's no fixed income trading. So in that sense, there will be more focus, but perhaps a little more volatility, but less volume on the equity side. Just be aware of that. So there's no trading. As far as the next important data is the PPI number, and that's on Wednesday at 5:30 a.m. But also, if you last few months, we've been really paying attention to the FOMC meeting minutes, and that comes at 11 a.m. Pacific Coast time, West Coast time at 11 o'clock. So be prepared. That's Wednesday, and that's what the markets are gonna react. If there was something really in those meetings that they were not transparent, or let's say you could read some of the presidents, they have objections, so it will be important to see what the thoughts are. But this is the biggie, Thursday at 5:30 a.m. and you will have the CPI numbers month over month and year over year, as well as the core CPI. So definitely want to pay attention to that. If you want to have a trade, this is very similar nowadays to our non-farm payroll trade strategy. So you could also have the CPI trade strategy, because the market is definitely going to move. And again, this is something that the Fed is watching, and this is the last one they're going to have. So pay attention to that. On Friday, we do have the retail sales. We really want to see what's happening. And as I mentioned, consumer sentiment is important. And speaking of that, at 7 o'clock, we have the preliminary University of Michigan consumer sentiment, as well as their inflation expectation. All right. Those are being prepared for next week. As always, we want to look at you can see our bond, our rates, and you see what happened in UK. And then, we had this thought of, having the biggest tax cut in 50 years. And then now Prime Minister Truss coming, kind of getting back and rephrasing what the idea is, she's turning back on that. So the yields had gone up very much, and there was this bond buying ideas and other things. So the yields came back down a little bit. But this is the biggest one I pay attention. We're still looking at the inverted yield curve. This is as of, again, yesterday. This is where we were exactly a month ago. So we see the 2-year, we've been talking, went over 4.9 at 4.3, and our 10-year is at 3.88. The spread is about 0.42 or 42 basis point, and 30-year is at 3.84. So you see this inverted yield curve is continuing. So let's take a look at the market. We start with the sentiment. This one, AII, it comes on Wednesday. So we had the 2 big days, if you recall, Monday and Tuesday. So there was a little improvement in the bullish stance, a little improvement on the bearish stance. So this is where we stand. We still see the spread of about 30 points. So the bears are way in control. So the negativity is there. The same thing with CNN, fear and greed. There's still extreme fear. And the same thing with the Citigroup. We are actually at negative 0.21. So as I've said before, that this could persist. I mean, sometimes it could be a short term, and we've had the oversold from the technical point of view last week, and we talked about it on Friday, and I will go over more, that the markets really were ready to bounce. But was that a short term or a really big turning point? So that's why you want to pay attention that they could have valid reasons people are negative. The only thing is, as I said, I still don't see it. I don't get nervous people that we don't have a limit down. Remember, if you during the panic of COVID time, we will have limit downs every day. Just people were very scared. We haven't had that, and I call that capitulation. So that's what I'm still not convinced with these. Again, from the sentiment point of view. So what kind of a week did we have last week? Believe it or not, even despite what happened on Friday, we had two big days on Monday and Tuesday, and the Dow Jones was up 2.2%, Nasdaq was up 0.73, and S&P was up 0.151%. As you see clearly, all of our indices are in a bear territory. S&P is down over 24% from its highs, and Nasdaq is down over 10%. As a whole, the U.S. markets were down they were up 1.66. Interesting factor is, and we will discuss it in the future, is, and I've talked about it before, that the U.S. small value was up 3.15%. So we want to put again your analytical hat and look at the situation. Strong dollar, multinationals, looking at the big caps. What doesn't affect these strong dollars is the more local, smaller businesses that are not really growth oriented, they are local, and we look at more on the cash flow side. So generally, those could be an attractive place if you're looking at the value for the future. That could be a good list. And as long as the dollar keeps going up and stronger, it's going to affect again the big cap. So I think that was one of the reasons, and they did better than other segments. So look at our usual, our Fibonacci and the moving averages. And as you can see, we last Friday, we violated the low of the June 16th. That was the low of the year. And then we went down. And what did it happen? We actually had the two big bars. And they were, again, the markets were very much oversold. But also from technical point of view, we also had, we will see on the charts, the next chart, you see that we were in a pivotal point. We were also, again, we had reached the low of the year, and then the market came back up. But where did we go? And this will be a common theme. After 2 days, we did not have enough power or juice to go through our 21, 20, 18 day, whichever you choose, depending on, what is your favorite term as far as the moving averages. That was resistance, and we could not break through. And that's not a sign of a strong or turnaround market. We are back. We are not back to the lows. So we are back. This is what I want to think about. Now, okay, we got the non-farm payroll out of the way. The question is, this bounce was really oversold on a pivotal point. The problem now we run into, we really spent that energy on the oversold. We are not oversold anymore. So that energy is gone. So that's why, again, we want to pay attention to Monday to see if we break this down, and I've said it before, 3,500 and perhaps even 3,400 will be in horizon. If we bounce back, then we know that bounce back is not because of the oversold, but actual buyers are coming in. So just a food for thought, because again, markets are kind of a self-adjusting organism. In a sense, again, when we are really overbought or oversold, they like to get the air out. So this time, again, we are not oversold and not as much. So let's see if this will hold. Talking about that, this is a new one, but I use it. These are three very short-term moving averages, is 8, 21, and 34. They're exponential, and they are Fibonacci numbers. And a couple of things you will notice, and I call them bow ties. When they all the moving averages contract, they come together and then they expand. They're pretty good turning points or confirmation. So for instance, here we broke down and we did go up, and then here, as far as breakdown, we can see that both that the moving averages came together, and then we were up above, just one above the 21 and 34. And that's another reason I emphasize, and you see this a lot, I like to have two candle confirmation, two closing candles. So in this situation, we had one, and then immediately we got rejected. And that tells you that in this situation, that was a false breakout. And as you see, the rest is history. And here again, we hit that 21 moving average. So now the question is, what happens to these moving averages? So if they really spread, then that will continue. So we want to look at, again, the contractions, we get our confirmations. Just be patient. That's what it is. The other thing I want to look at very long term, I want to look at NASDAQ on a monthly basis. And I use the Fibonacci going back from the low of the COVID to the high of November 21 when we hit the really all-time high. And what happened was, you see the retracement, we came back to 38.2. We really floated. It's on a monthly basis. Then we went to the zone of 38.2 to 50. And at 50, we've been bouncing back and forth. In the last 2 months, well, this is we are not done with October, but September, we are in the ambush zone. So I just want to give you some figures. These are on a monthly basis. So this is for NASDAQ, which I think NASDAQ is of all the indices, is obviously, we've talked about, the most reactive index because of the interest rate and the dependency on the rates, and again, being a growth, especially mega caps. And this is the NASDAQ you want to really pay attention. And these are the crucial points. You can see in October, we did go hit that 50% retracement zone in the area, and then we got rejected. We want to pay attention that. This is on a monthly basis. Next, we talked about it last week, and I said, just watch for this. It was a 200, right? Look at all the moving averages. This is a weekly of S&P cash. And last week, I showed you that we were right at the 200-week moving average. And basically, that's where we bounced. Question is, now we are inverse hammer, it looks like. So we're still above that 200 weekly moving average. It's about 35.90, somewhere around that zone. Would that hold? Next week, we have to see. Again, we have a big information, or the data is going to come on CPI. We also have the FOMC meeting. So it will be a very crucial, I think, one of the most important weeks next week, besides the banking numbers coming up. But I think that CPI number is going to be it before the next FOMC meeting. So let's pay attention, because once we break down, and this is my next chart, is we look at the NASDAQ on a 200-week moving average. And now we actually have had two confirmations. We try to return above that 200-week moving average, and it's like a doji, it's like we could not. So this is a really a crucial week. If we cannot, then you can see we've had the lower lows and lower highs, and basically we tried to reverse that last month, could not. So now let's see if we're going to go to the lower lows on a weekly basis. That doesn't look well. On the other hand, the Russell we've been watching. So the Russell has broken also below this 200-week moving average. It did it not long ago, and it ended up actually coming back and then hit the 50-week moving average. But now we are back, but this is a major support zone that we are in. So let's look at the Bollinger Bands. They're going to be a common theme, and all of these major indices, you will see that I will repeat myself, and the S&P cash, what did we do? We went to the 18-day moving average, got rejected. We were oversold. You recall last week we talked about it, and but what happened now? We got a resistance. We're coming back. We basically 50 line in the stochastics, and we didn't even. And the same thing with CCI. One word of caution is on the MACD. So you could see MACD crossed it last week. So that gave us the momentum change. But you have to remember, we are under the zero line. You see this, that the histogram is for the momentum. This is the trend. So when the lines are above the zero line, that means we are trending up. When we are below, we are trending still down. Except, again, when the lines cross, that means the momentum has changed. So the momentum, if it's on the buy side, we get the green histogram shows us at the cross. But that doesn't mean the trend has changed. So we're still in a downtrend. And this will all repeat on all of the indices. NASDAQ, again, 18-day moving average. Same thing with the Russell, even though it's been a little stronger, but it's still 18-day moving average. Dow Jones, the same thing. And in the transportation tried, and it's a little stronger, so we shall see what happens. But we got still rejected downwards moving average. So I'm gonna watch that. Now, the next is VIX. We've been talking about VIX, and that's telling us, again, I talked to you about backwardation. So it still has now opposite of the other ones, VIX has been holding above its 18-day moving average. It get rejected last week. We talked about that, above its Bollinger Band. It was important that it actually was above it for 3 days, so finally got rejected. But we said there's still its strength. When it goes up the 3 days, that means there's still movement left. And the other one was that VVX. We've been doing nothing. The Bollinger Band has been really consolidating and being a funnel or a snake. And then now we just opened up. So you see, we're still above the 118-day moving average. Well, everything comes to that 10-year yield, and we can see that we are expanding. The yields are going up. The fear of that, there's a hawkish Fed out there. And look at what happened to the 10 years. The 10 years, on the other hand, been below their 18-day moving average. Same thing with the 30-year bonds. Now, this continues below that. But one thing I want to take a look at is, look what happened on a weekly basis. Drip, drip, every single week, we've had the downward selling of the 30-year bonds. And the question has been, the markets are taking into account that have the recession, there's a chance that in 2023, that's what the markets have been telling us, that the Fed might even reduce the rates. So because of that, long-term bonds have been attractive in a sense that they've had lower yields. But the way now they're behaving, they're not too sure. They don't think the Fed is going to stop at, let's say, 4.25%, 5.4. Of talking about 5%. So there's not much thinking that, oh, the Fed next year, they're going to actually turn around and reduce the rate. So pay attention to this. You see the Bollinger Bands are opening, so weekly basis. And the financials, as you can see, financials follow, again, the markets as well as the rates. So again, higher yields should be good for them. But if it's too much, interest rates are higher, the consumer borrow? Where the borrowing is going to come from? Are they going to be hesitant? So there goes that spread. So we want to pay attention to that. And that's what's important, really, that next Thursday, and especially Friday, we want to hear what the banks have to say. Loan services, the loan activities, the defaults. We haven't had defaults because, again, that's what the job market is helping. But what is their outlook? Because if that's the case, that's gonna, even though the yields are going up, it should be healthy. What that means is they have to pay higher interest rate on the short term and not getting as much activity on the long term. So pay attention to the language next week and forecast. The dollar is it. We talked about the dollar temporarily came down, but look, right under the 18-day, it closed and came back up. So that means that the uptrend is continuing. And because of that, it's affecting everything else. Look at the weekly. I mean, we've been above that 18-week moving average, very healthy. MACD is up. We are embedded in the stochastic. And although it's turning down, CCI is still above the 100. So dollar is it. And the euro, again, temporarily went above 18-day moving average, got rejected. British pound, we've talked about. British pound tried again. The two candles went up and came back down, and we were overbought, and now it's turning down. And then the gold had some oomph, and we're still above 18-day moving average. We talked about it last time. It was, it will be a range bound. Seasonality is coming into the picture. Of course, a strong dollar and higher interest rates are not helping gold. But in this area, was haven't hit the Bollinger Band. It could go around 1800, 1850 maybe. But right now, again, this went right now. But they did have a nice 2 days, and they're consolidating. Silver has been the surprise. Silver has been much stronger. We have broken above the 100, although we are now overbought. So we want to see hold above the 100, or will that turn around and come down? The copper is consolidating right now, and Bitcoin again. What can I say? There's again. I mentioned in our class, as far as the elections goes, it will be important what the hearing will be from the SEC, or what the regulations will be. So basically, look at the volatility and nothing. I mean, the Bollinger Bands are really narrowed. 17,000 is a crucial point for Bitcoin, in my opinion. So let's see what happens. Even this is, I go to 19, 20, come down. So watch that zone if you break. Now we have talked about, and we will go further in our lesson of the week, our emerging markets, about crude oil. But what I have to say is, again, this fundamentals in commodities, they are the most important thing you want to pay attention. We pay attention to the technical, and we broke down below the 80, but fundamentally, I had said it, I guess, many times, that I think $80 to $90 is a sweet spot for many OPEC, and it really, these countries, OPEC countries, and of course exporters, really enjoying this, and they use all kinds of excuses. I've said it before that the strategic reserves, when we came with huge amounts, was not, I didn't think that was advisable. Now there's a question whether President Biden's trip to Saudi Arabia was advisable, because Saudis does whatever Saudi does, what is good for them. And really, I think we used the poker game, we really used to open our hands. One of the other biggest problems we have is, I've said it before, it is about the refining, the production. We don't have all the capacity yet. We've got to fix them. Is from the logical point of view, they need funding, and then becomes political. Like the Keystone, that should have, that would have helped in the world managing the prices. So that was not open. We are all for clean energy, definitely, but we are not there yet. We cannot punish all the fuel producing companies. I'm talking about fossil fuel or the natural gas. We want the whole, everything to be clean air and clean energy. it has to be timing about it. Gradually, we can move on, and we have learned from all the mistakes that was made. But when you shut down something, things like this happen. You can see there's a huge move from the crude oil. I will discuss it a little farther with OPEC, but yeah, pay attention. I think the winter is coming. Any bad winter, Europe is going to be in a very big trouble. So, and then energy stocks, obviously, they had a really good week because of the crude oil. Although they were the only sector up on Friday for a while, and they also gave up, but they've had a nice move. The last but not least, we've been talking about this, the high yield bonds. They actually give us a heads up as far as the markets, but they did have a nice bounce like the markets did, and then that 18-day again, very similar to other. All right, let's talk about expected move. Now, one thing we've talked about in the past 10 weeks, we said, it's been jittery. The market makers do not like it when every time we close at the end of the week outside our expected moves. That means there is no really as far as stability, and they are, remember, 68% of the time it's supposed to be close inside the expected move. So it's making things a lot more volatile. So but last week we stayed in, and look what happened this week. And this is, again, repeats in all the other indices. You see, we had a great Monday, and Tuesday we went outside, and then on Friday, we came right inside the expected. Same thing with NASDAQ. We did the same thing, went outside, came and closed right orderly inside the expected move. And same thing with Russell 2000, inside. Even the Dow was up big time, and it just closed inside the expected move. And even the bonds, they closed right on the opposite of what the market doing. It's closed, but they closed inside the expected move. Now, gold had a good week, so they went up, and it just came right outside of their expected move. And silver has been strong, so silver stayed outside. Financials is similar to other, like S&P, came inside expected move, but energy, standard deviation, they were very strong because of the crude oil. The expected move, remember, we're going to have the bond market will be 4 days, so Monday will be an interesting day for the equities. The expected move is about $125 and 8 cents for the. All right, let's discuss something. I got a few charts on emerging markets. First, as always, this is a Wednesday. You see, again, Monday and Tuesday was big up day in the United States, and it carried with it almost every other market. But year to date, again, not many blue. You can see a lot of red, very few, and commodity kind of oriented Brazil, Argentina, and Saudi Arabia. The other thing is, International Monetary Fund, what they do is, obviously, they're the one who help the countries. They look at it as a World Bank, so they give loans. And I just thought it would be interesting to see, since the start of war, how many countries have been affected. By the way, I get up with an asterisk here. Some of these countries really had nothing to do with Ukraine. So IMF was planning of helping them, especially Argentina, at a $41 billion loan, and that was done in range on the March 25th. But I just want to show you, how IMF works. Is like the world. We have the World Bank, and then had the monetary funds that, in a sort, they give different ways of financing countries. So just a few names here. There's some, you can see Africa, Lebanon has, unfortunately, horrendous situation there. Their currency is just, their banking system is just going to buckle. So, but you see quite a few in Latin America and Africa. So let's talk about OPEC. So what did the OPEC do? They come back, as they said, they decided, now this is after the visit of President Biden, and they were supposed to, not to cut the output. They were going to help. Again, there's a Ukraine situation. What did they do? They came back and said, oh, we're going to cut our production by 2 million barrels per day. Now, the interesting thing is, even the previous, and there's an OPEC plus, because Russia is also involved. So they had all the promises that they've made. They actually, even though they supposed to have the quota, they still undercut it. So what I mean by that is, you can see the Saudis had supposed to have 11.03, they did 10.97. Iraq was 4.66, but they produced 4.45. So these reds, that's what it means. Weight was right on target, but look at Nigeria, it was 1.83, they only produced 1.16, or sold. Angola, big one. So basically an average, and then Russia was undercut too. So whatever they say, even they say 2 million, they're going to undercut it. So obviously it's supply and demand, and they're really enjoying. They want to keep that. I think the $90 area is really healthy for them. Speaking of that, I want to look at, of all the Gulf states, which ones are really dependent on oil and how it affects their GDP. And that's why we've talked about some of these countries become really smart. They're diversifying rather than depending on the oil exports. But you see, Kuwait is the most dependent on their fuel exports. 82% of their GDP comes from Brent, and this is Brent averaging over $100 there. So it was in the 90s right now. Qatar is second, Oman, United Arab Emirates, and you see only 46%. Saudi Arabia and Bahrain is 25. A couple other news. I just again want to look at all over the globe. Now, the Portugal actually they lifted the 2022 GDP. They revised it upward from 6.3 to 6.7, and this is a good news, citing its strong recovery because of the tourism industry and private consumption. So we've talked about it in the past. I know the charts about tourism. Strong dollar helps countries where Americans to travel. But this is one thing you want to make sure to take into consideration, that they're signaling a slowdown in 2023. So it's a warning sign. Another interesting thing I found was, we talk about Africa and, my feelings about Africa, and because of their demographics and technology, they actually attracted $3.5 billion in venture capital investments. Now, the whole world global, we've had a decline. And here they attract in the first half. And the funding raised by 300 companies, and that growth of 133% compared to the previous year. And we've talked about fintechs, and that fintech really attracting more and more investment in those countries. And that was 89% of the deals in the financial sector. Now, West Africa is more advanced, so they actually had the largest share of the deals, but East Africa has the biggest growth compared year over year. So again, with forethought, again, we are not talking about all right, so that's what I want to take into consideration. Now, last Sunday, we had the elections in Brazil, and what we looked at in Brazil, we mentioned that either way, this is just such a kind of a Congress is not unified. So basically, whoever wins, it's not going to have a big platform in this. But as far as President Lula, well, ex-President Lulu, he had a really upper hand. But I'm going to talk about these basically these polls and opinions. So President right now, the scenario is he's the conservative, and what happened? He got 43.2% of the votes, and Lulu got 48.4%. So Lulu won by 5. But again, in Brazil, if you don't have a majority, if nobody wins, takes above 50%, there's a runoff, which is end of October. So there will be another polling, and the election will finalized at that time. But the interesting part is the highest, you can see that the recent opinion poll low and the recent opinion poll high. The highest for Bolsonaro was 40.7, and he got 43.2% of the votes. And for Lulu was 49.8, and he came vote. So he did better. And you know, the idea was he will lose by 8 or 9, and he was down by 5. So you know, Brazilian equities, we've talked about it for the last 9 months, 8 months. We talked about how Brazil actually started increasing their interest rates. So the real rate, the real yield is attractive because they've been working on that. So basically their equities and then the Forex rate, FX rates are up 8%, and equities are up 8%, and FX is up 3%. This is end of September, so or October 3rd. So basically, when we go back and look at the valuation, the price to book is 2% discount, 20% discount to the 5-year median. PE ratio is also the forward PE is also 50% discount for the 5-year median. And also, although they've had appreciation on their FX and the real, but they're just going back to the mean reversion. So you can see just the price book, it could go a little lower, but they are in an attractive place. Just again, from emerging point to emerging markets, this is more of a valuation. So that's something to consideration. About valuation, one of the things we look at, of course, the PE ratios, but we want to go more than that. There's something called CAPE ratio, actually called cyclically adjusted price to earning ratio. So you don't look at this day, they look at the 10-year average, and it's called, you know, Shiller PE or the N ratio. And, you know, we use that in S&P. That's much better than just year to year. The PE ratio is adjusted. So what I thought it would be interesting to look at all the countries around the world, the major ones, whether they're emerging or developed. And we just didn't want to look at just the PE ratio. There is adjusted on the dividend, and then you have the cash flow and the book. So these are the ranking of all the countries. The average for foreign development, the CAPE ratio is 18, the median is 15, and emerging markets are 13. So this is food for thought. You're looking at a long term, you're looking at the value. You want to value a country, you see some good stories. So basically, I let you go through this. Where US is, US's CAPE is 26. There, I'm going to go to the price to book is 3.6, and basically the cash flow is 16. This is how low they are. So they're pretty richly, even though after all the sell-off, they still have been very richly valued. So this is one of the ways you can start analyzing the countries based on the valuation, see, you know, that there is something to study more. All right, so that's our emerging markets. I hope that was helpful. The lesson for this week, as always, I like to look at the charts. We wanted to look at the inflation adjusted Dow numbers going back to 1900, and this is our channel. Basically, you can see the long-term channel, we have violated it. We went up, now we're just coming back down. And we also have a channel from 2009 financial crisis. We are on the end of, the lower end of it. So if you're looking at the cyclical side of it, you want to differentiate, are we overbought? Are we going to keep going down, or are we going to bounce from here? A very crucial point. That 30,000 area is very important. So we're looking at that. Just for the food for thought, I want to write this down, that the Dow has traded at or above this resistance line, long-term resistance line, in 1901, 1906, 1915. Remember that 1929, 1966, and 1999. So food for thought. And then the last one was obviously past years. Another thing, just a tidbit, talk about cryptocurrency, just a little news. You can see Binance blockchain hit by hackers who stole about $570 million. So that's why I think it's important. And again, talking about the security, talk about cryptocurrencies, things like this could happen. And either most of the assets were found in the hacker's digital wallet address, but 100 million worth of the cryptocurrency was unrecoverable. So for thought, as far as how still we don't have clarity with the cryptocurrency. The other thing, again, talking about strong dollar, I thought this was an interesting tidbit. American companies are on pace to reshore, or means return to US, nearly 350,000 jobs. Now, we just talked about the job market. They're bringing back, if you recall, remember Apple did that with tax reasons or whatever it was. I think that was the reason. According to a report by the Reshoring Initiative, that would be the highest number on record since the group began tracking the data in 2010. That's something to think about. Again, the strong dollar I mentioned in the companies. For you soccer lovers or football lovers, this is the Forbes list of the highest paid footballers in 2022. So for the last 8 years, we've either had a Messi or Ronaldo. This year we have a new number one, it's Kylian Mbappe. So he made, for 2022, 2023, he will make about $128 million this year. Messi, 120 million, and Ronaldo, 100 million. Neymar is next, is 87. Salah is 53. Holland is 39. The rest are lower than that. Lewandowski, Hazard, Iniesta, and De Bruyne. The interesting fact is, you got only two really under age 30. It's Mbappe and Holland, 23 and 22-year-olds. They're the only, two out of the 10 are under age of 30. Food for thought, was close to that. Other thing I was thinking of, looking at ideas for the trading classes and other things. So I thought, what kind of type of traders are out there? And this is interesting that you can actually even you see it yourself. Talk about, the psychology of trading, talk about business, trading business plan and all that. Really, there's 7. There's option and stock trader. Perhaps you can think of Robinhood trader, the real estate investor, and you will see a lot of those. The retired by age or business sale, don't have to be old. The trading novice, some people got really excited, just think of last January 2021, and the meme, they want to get into and make a quick money. Then you have the trading professionals. That's what some of you will be. The business person who has a business but also enjoys this. The last but not least, again, because of COVID and other things, a parent at home, because at home, spouses work and they like to do something else. So I think that's some type of just as traders go. We just had a class on midterm elections, so I want to give you a more update in the sense of just putting everything together. You can see these are the odds of the Senate going to staying with Democrats, House staying with Democrats. So the House is at 24% as of this time. It will stay Democratic. 78% will go to Republican. But as far as the Senate staying Democrat is 64% versus 47% going to Republicans. Now, also approval rating makes a difference. So you could see that we had the big drop for President Biden, went up 36. But in July, they had a nice up over the $3 trillion package, and that semiconductor and all that came through. So there was a nice momentum. The problem is now the momentum has turned, especially with the way, again, if the interest rates keep going up, what will happen, and the inflation numbers are important. So that is a crucial point, and especially now with the OPEC, gas prices keep going up. That this month would be crucial because people think very short term. They look at what happened in this day, this week, years. So I also had a chart for you, a different chart at what happens 12 months after the midterm elections, and this is following from 1950, 2018. You can see what has happened from November to November, and then this year by year from 1950, where we've averaged roughly. Just a good kind of a summary of what we did as a class. The last but not least, this is a picture of one of my workspace. I call them sectors of different categories, and the top 10 stocks in each sector. And then I have my currencies and ETF and the futures. And then we have the mega caps. This is Friday's closing. And by just looking at that, visually, you can see it was not a pretty day. Then you can see, well, what was up in the futures market? Wheat was up, sugar was up, soybean was up, orange juice, dollar, crude oil, cocoa, corn, the volatility of VIX, and VIX itself. The reason I want to share that with you, there's nothing really in the dollar versus Swiss franc and dollar yen, and DBA is your commodity ETF. So basically, what that tells you is, first of all the stocks, they really had a bad day, so that was sell off in all the markets. But also, that's the reason I want to learn about different commodities. Even in really ugly days, we do have some gains. So it is important to diversify, understand there are ways you could have traded gold, crude oil, or you could have traded dollar, or if or wheat or corn. All right, almost at the end of our presentation. The trade of the week. First of all, again, these gap plays, please pay attention. And they've done well. I mean, you look at Wednesday, for instance, we finally filled that gap. And usually once we fill it, we kind of basically we get the closure, and then that was a sell-off. And then we also had a gap down on Friday. On Thursday, we filled that. This gap is basically filling this gap. So you could have a gap that fills another gap. So just be aware of that. So you see how nicely this gap was filled, and this is a line. We did go on Friday. We just went down, and you see this line, which was that gap, became a resistance for the day. So it's a food for thought. So the gaps are important, and they do fill, and this was filled from Tuesday. Now, this doesn't bode well. This is something, when you have two gaps up or down, this is called island. So this island doesn't get back up, usually becomes a top. So pay attention to this, the high and the low. If you cannot return and go back up, usually for a while they'll stay. The other thing I want to take into consideration, again, remember that 39 to 39.30 zone, that pivot points we've talked about, once we broke it, that could be your next, if you wanted to see the markets have reversed and they're gonna go up, that would be the first attraction, that area. And if you break above that, then you've got the confirmation that could be a beginning of a move. So until we break that 3,900 area, this as far as the trades go. What I did on Friday, I had a couple of trades, and this is on Friday toward the end of the day. I just want to share this with you. And the reason I want to share this with you was really scalping. It took me a minute. It's a 5 AS trading. I got in about 12:39 and I was out at 12:40. Something, it's like just 1 minute, quickly in and out. I just want to share that with you. It was average, it was about 120, 140 for each time. So it was about $700 profit loss. And I mean, profit. But that was like less than a minute. And the reason was it was Friday and the NFP, and things really moved fast. And that was one of the things that you really, I am a very much on hand. I'm not a system trader. I'm a discretionary, and I'm very visual. So basically, you could see, this is on a 1 minute. This was a tick, and I was looking at the ticks. Really stayed above. These are my 20. We stayed above the 20, and that's when they said this is going to be quick. These are not the time to be a hero and buy and hold, or I just want to go in and out. And you can see it, I just did one at a time, and I did that. And again, you could see the MACD was very oversold, the momentum, and I was out. I mean, once we got in here, and I was out around here. So it was a quick trade. Another thing was, again, I hope you do this NFP trade. I know it's pretty volatile, but when they work very well. But you can also do it with options, in a sense that knowing that, and we've talked about this, I don't know, for the last 18 months, I've shown you that usually that 5 minutes, could be even 2 minute bar, it happens at 5:30. Most of the time it's the high or the low of the day for you. And look how beautifully it became. We never reached that high, and this was the low. We really struggled around that low, and finally we broke down, and that would have given you even more reason to know that there's a lot of selling going on. But this is important. That's your NFP trade. So once the momentum starts, if you look at this on 1 minute, 2 minutes, it continues. Same with bonds. Look at what happened with bonds. This is where the numbers came. This was the low, this was the high. It was a really nice reversal, but where did we go? Double top, right at the high of the our 5 minute bar. Oh, actually it's 2 minutes, my 2 minute bar. And that's the 10-year. So if you're trading bonds, this is a great trade if you would have kept up, but you see the double top. So if you're looking for trades besides our, other bracket trades and other things, NFP CPI does the same thing. So watch for that. All right, quickly, ETF of the week rather than just one ETF. I thought to show you that there are some new ETFs coming from Direxion, which there are, again, they use a double, triple, but there's a new one that's coming on the electric and autonomous vehicles. We do have like Drive or EVA, but this is it's a bullish. If you're bullish about it, they're coming with EVAV. But also we have the single stock ETFs. I mentioned to you about Apple, AAPP, the inverse or the bear Apple. So if you don't want to short it, but you want to use ETFs, you could. One-time bear, but now they're coming like 1.5. They are using for Amazon, Google, Microsoft, Tesla. So this is one of the ways. The volume is not that much there yet. So you see if this gets attraction, but it is something that you can follow if you like. There will be options on them too. So, but these are the things that if you don't want to short Tesla because you feel like it's very difficult, things happen, you can actually then go and buy TSLS. So just the last next on the ETFs is, I just thought this is interesting, just came out October 6th. Fund that helped investor bet against Cathie Wood takes aim at Jim Cramer. So I don't know, some people love and hate relationship with Jim Cramer. He's a great entertainer. So now the Huddle Capital, which they came up with SARK for shorting ARK, now they come up, it's called SGIM, short Jim. So that's at work, just for you. And they also, if you love Jim Cramer, they're going to call it Long Jim, LGIM. So those are the two ETFs at work. SARK has been up 90%, and I think I came out right in November. I think we had, I mentioned, there is a SARK ETF. Just if you go back and at it, is up about 90%. Stock of the week, just a food for thought. This not just do more investigation. This is a financial conglomerate, B. Riley Financials. There is you might reason just having this candidate, and you will see the screen for this. The charts don't look that great. This is we've broken down everything. We go to weekly. It's still not a lot of hope in horizon, but couple of things that attracted me to this: the insider transaction and the short flow. You see there's a 17% short flow, and the transaction insiders have been busy. There's the directors. I don't really look at this, the ownership, the 10% ownership, but chairman has been, buying at 46, 47, 48, 49, and there've been some buys at 52. Just a food for thought. These are as I said, it kind of interests me when markets are being so down. Basically, when there's a big short flow, there's an insider activity. Talking about that, I'll show you the screen. The Dow Jones, as far as the short squeeze, the squeeze plays, I chose Dow Jones Industrial Average. There's 3 of them if you like to do more investigation. And this is where the idea came from, for this year. This is the whole year. There had been some 18 insiders. I don't really put a lot of value on the 10% ownership and the directors, but anyway, it's there. So these are a list, and then these are some of the cells. So you can look at that. And also I want to look at the free cash flows. Who are the biggest free cash flows in the companies? And Apple has $78 billion of free cash flow. So just another screen. This is important. Be prepared if you want to do earnings, or pay attention to the earnings, because it is something that is going to give you the guidance. We have the PepsiCo next week on Wednesday, but on Thursday before the open, you have BlackRock. And then I would be interested to hear Delta, for instance, what they think, and Domino's Pizza. Friday is a biggie. Friday morning, please. That could be a market mover. So Thursday, we have these before the open, then we also have the CPI. Friday, we have Bell numbers and the consumer numbers, but also we have JP Morgan, Morgan Stanley, Citibank, we have Wells Fargo. There's just so many. So these are the volatilities. You can spend JPM in quite well 5.5. So just review this. I know I put every week. I don't want to take your time to go through every one of these, but you have access to the slides, so read them, see what are the projections and predictions, between the one semiconductor and PepsiCo and Delta, these Morgan Stanley, Citi, United Healthcare, BlackRock, Wells Fargo, Domino's Pizza. Great. All right. that in mind, what I'm going to do, stop recording.